Okay, we're down to myth number 8 now. Momentum is too volatile to rely on. And this could be similar to the sporadic myth that we talked about before, but we note that the Sharpe ratio should take into account this volatility. And we remember from one of the prior myths that the Sharpe ratios for the momentum strategies were pretty high compared to the other factors. And so the authors think that whenever naysayers note high volatility of momentum, they're talking about the tendency for very bad short-term periods, and in particular, that was in 2009. And the authors note that, of course, as with any other factor, any other strategy, there are times when the strategy does not make money and may have large losses. And again, the authors are teaming momentum up against value, and they say that in the late 1990s, value companies had a really tough time. And since the momentum debacle in 2009 was a little more recent, then maybe it's more top of our minds when we think about losses in momentum strategies. But the authors note that the higher Sharpe ratios that we found before are included in the periods of the high losses and volatility in the momentum strategies. So overall, they've performed well when normalizing for volatility. And so the authors argue that definitely 2009 was a bad year for momentum strategies, and especially if that's all you do. But then, 1999 was also tough for value investors, and 2008 was tough for passive investors. And they go on to say that 1932 was really tough for momentum investors, and 1930 was bad for value investors. But the authors want to reiterate that if they had used a strategy of 60-40 value and momentum like we looked at in the prior myths, then the volatility would have been rather calm. And so the authors want to caution people from saying that a factor is all bad just because it has maybe one bad period. And nevertheless, the authors are going to dig a little deeper into this volatility and how it maybe has bigger left tails that would be mean very big losses than maybe the other factors do. So let's dig into those studies. Looks like Daniel and Moskowitz in 2013 looked specifically at these momentum crashes to try to understand how they worked. They found that typically it happens shortly after a long bear market, which is followed by an abrupt market upswing. And so this perfectly characterizes the spring of 2009 and also the summer of 1932. So it would be that after a big market crash, investors or the market will go up really quickly and really high, but momentum investors will have missed out on that because they are selling those securities that recently had the big loss instead of buying them. And to put it in more technical terms, by buying winners and selling losers, a momentum strategy following a bear market will be long the low beta stocks and short the high beta stocks, but whereas the high beta stocks are the ones that made all the money, but you're actually short, or they made higher returns than the low beta stocks, but you're actually short the high beta instead of the low beta, so kind of missed out on the big upswing. And in fact, Daniel and Moskowitz in 2013 found that all the crashes to momentum are driven by the shorts to the losers. The winners actually fared okay, but being short the losers, which were the most volatile stocks that went up, you actually lost significant amount of money compared to the winners, which weren't as volatile and didn't go up as high as the losers went. And actually, if you remember from myth 2, we were talking about how shorting is the only way to earn momentum returns, as being a myth. But actually here, by shorting the losers, you're actually hurting yourself in the momentum strategies by shorting the more volatile companies during a big upswing. So what's interesting about this, though, is that the momentum strategy of buying the winners and selling the losers shortly after a big bear market and in an upswing, for a long-only investor, he would have actually maybe paired out okay because the overall market is going up anyway, and being long only, he would have some pretty reasonable returns instead of being short the losers. And so to combat this scenario of the market crash and then the upswing, the authors again are proposing the combination of value with momentum, and they say that this combination effectively eliminates the crashes and the long-term sample evidence, and not just for the momentum but also the crashes that occur for value investing. So they emphasize that the diversification benefits of combining value and momentum, isn't just good during normal times, but also during extreme times. So the authors reference a strategy by Asness and Frazzini in 2013 that found combining value and momentum in a strategy doesn't make 2009 as bad for momentum strategies, and also in value's case, it doesn't make the 1999 period for the value strategies as bad when you combine value and momentum together. And the authors note that certainly there will be bad times for both factors, but there's going to be fewer hard times, or at least the past studies have shown that. And it looks like the authors did pull some of Ken French's data from his website to explore the combination of momentum and value and the volatility related to it. And so they found that using just value strategies alone, the worst drawdown was 43%. Using just momentum alone, the worst drawdown is 77%. However, when we put them into a 60-40 portfolio of I think 60 value, 40 momentum, the worst drawdown is only 30%. So it looks like it kind of mitigates a little bit of the downside volatility by combining value with momentum. And so we remember from one of the first couple of myths in this paper, the 60-40 portfolio had a significantly higher Sharpe ratio, which would mean that the returns divided by its volatility is a lot higher than either one of value or momentum strategies when used alone. And so in summary, if we were looking at the momentum strategy as a whole, we shouldn't analyze it just on the 2009 bad period, but look at it across the entire sample period, which was from the 1920s all the way up to 2013. And over that entire period, momentum fared really well. And so did value strategies. So we shouldn't just look at value in the 1999 period when it did really poorly. We should look at it across the whole period when it does well in spite of that poor 1999 period. And again, combining momentum and value improves these results even more. So let's take a look at myth number 9. Different measures of momentum can give different results over a given period. So it looks like the authors note that this myth is actually true, but it's used in maybe a negative light or a critique of momentum when actually maybe it's good. And so the argument with these naysayers is that maybe momentum is actually just data mined, where they can kind of come up with their own method of measuring momentum to try to earn the highest return instead of maybe using out of sample data or some way that is replicable. And the authors note that with any strategy, you can use different measures to measure the same phenomenon. For instance, I guess value companies will use earnings to price or cash flow to price or book to market value to try to figure out the best ratio when implementing value strategies. And of course, all of these different ratios are useful over the long term, but in any particular smaller period, they can provide different returns. And in fact, it's been shown that using multiple value ratios or indicators instead of just one gives better results. So maybe the same thing can be used of momentum. And so the authors note that momentum can also be measured in various ways. The most simplest way would be looking at the past 12-month return to rank the stocks according to their past returns, and excluding the most recent month. It's common practice, the 12 minus 1 strategy, to avoid microstructure and liquidity biases. And that's usually the most frequently one that is used, especially since Asness in 1994. There have also been other measures proposed, for instance, different time ranges, but also different measures, for instance, earnings momentum or revisions to analysts' forecasts. And as was shown in back in '96 by Chad Jagadish and Lakanishik, each of these measures, the earnings announcements and analyst revisions and so on, each have their own way and are just as effective at predicting future returns. So to guard against the data mining, using the simplest measure, taking an average of all the measures, seems to be the best way, which is found in 2013 by several of the authors of this paper. And interestingly, several authors find and claim different past time periods to measure the past returns, and each of them finds something different. For instance, this paper found that the past 6-month returns is not very useful and that you should use the past 7 to 12 months, but other authors found that that wasn't the case when looking at international markets and other countries. And in that case, they found that the past 12-month return is a superior measure. And it was found that the recent past 6 months was just about the same as the farther out 6 months when getting the entire 12-month past return. So both of these ways that were argued by those two authors are about the same, but it seems that the simpler way is the best way. So the fact that different measures of momentum yield similar results should be taken as a sign of robustness and not really as a critique. So let's take a look at myth number 10. There's no theory behind momentum. And so a good measure of the validity of anything is to understand the why that it happens, and particularly in momentum, it's debated as far as whether it's a behavioral phenomenon or is there some kind of risk-based reason for it, but the authors note here that the size and value and other factors don't have a definite reason for why they happen either. They're all much debated. So, how could you say that momentum doesn't exist when just because it's heavily debated when these other factors are heavily debated as well? So, most theories fall into a risk-based or a behavioral reason, and those two reasons are hotly debated for momentum, but they're also kind of debated for size and value premium as well. So taking a look at the behavioral reasonings for why momentum occurs, there are typically two behavioral reasons that have been found, and one of them would be that underreaction to new data. So that would mean that it just takes a little while for the market, the prices of the stocks to move up after new data is entered into the market. And so looking at that, it would be that the stock's return is less than what it should have been, and so it kind of moves up to get in line with where it should be and continues on that path. However, the delayed overreaction would be that investors actually overreact, or there's sort of an underreaction to new data, and then they overreact, and then the returns go back down. So there's been a lot of debate as far as that, where in the last or after the first year, our momentum returns negative, and that would mean that there would be a delayed overreaction, so it gets back down to where it should have been the whole time. Or are the momentum returns after the first year basically zero? And so that would say an underreaction to information because the price of the securities just caught back up with where it should have been. So, and both of those instances have been found in different studies, so maybe they both occur, and that makes it a little more difficult to sort things out, obviously. And so some of the reasons that investors might underreact to information would be that maybe they're too conservative, they're not paying attention, they have liquidity issues, or they have a tendency to sell winners too quickly and hold on to losers longer. But in the case of overreaction, the delayed overreaction, investors may be chasing returns or be providing a feedback mechanism that drives prices even higher. And this would cause that, obviously, that maybe the prices in that security get too overheated and have to go back down. So anyway, the other possibility that momentum occurs is compensation for risk. So the idea here is that high momentum stocks face a greater cash flow risk because of their growth prospects. So maybe if a company is growing too fast, then there's a risk that they're not going to have enough cash to keep up with the expenses and the investments they're going to have to make to support that new revenue. So in that regard, maybe it should earn a higher cost of capital. But what's interesting is there seems to be a correlation in momentum strategies across markets and asset classes. So maybe there is a common economic risk related to momentum strategies. So the authors want to specify that whether or not the reason for the momentum returns is risk or behavioral based, it really doesn't matter. What matters is that it certainly persists, as we've seen in the prior myths and tables. But maybe it's a little bit of both the risk and non-risk based explanations, but there seems to certainly be persistence in momentum over time, and that's what's important to know. So the authors note that as long as the risk and taste for these risks don't change, then the momentum premium will certainly live on and be and exist for years to come. And also, if we continue to have the same biases and behaviors in the markets, then the premium should continue on as well. And certainly the evidence over the past 200 years of data, different financial markets, asset classes, etc., show that this momentum premium is certainly not a short-lived phenomenon. It's actually a long-term real thing. So the authors want to reiterate that even though some of the naysayers have said that momentum should just be used as a screen or an ancillary way of building a portfolio, just by saying to use it in a screen, or they're somewhat believing in the momentum strategy. And so some other naysayers have noted that momentum premium may not be large enough to trade profitably because it would actually be an example of market mispricing. And the authors note this seems like more of a religious statement than a fact. And this kind of boils down to or stems from the efficient market hypothesis, where if the momentum strategies really are this profitable, then that directly conflicts with the markets being fully efficient, and that certainly those returns should be arbitraged away. But as we've shown before, those returns certainly aren't arbitraged away, so then maybe there's the data that we're using related to momentum must be wrong. And so if basically a rational investor would require more return for more risk, and so if there's a mispricing in the market, maybe we're defining risk wrong, or maybe the behavioral explanations are the only explanations, but actually, maybe they both have some merit in explaining the momentum returns. The authors want to reiterate that certainly the data is undeniable, as we've seen in the prior myth sections, and also that has been found the markets may not be perfectly as efficient as some may suggest. But regardless of all the arguments, the authors note that it shouldn't diminish the momentum as a valuable investment tool. And so, how it comes about or how it works or any of that is less important than knowing that it's actually a good strategy to use. And as an example, they say that they discovered the world wasn't flat before we understood and agreed as to why. So maybe we should use that thought process when using momentum in investment strategies. So to conclude here, so in this paper, they've looked at 10 different myths related to momentum investment strategies and debunked all of those myths. And they did it using prior papers and also by looking at the data themselves from Ken French's website. And so they welcome others to do their own research and build their own database and try to explain different findings than would have been found here, or even to read prior papers and try to pick them apart, because of course momentum, just like anything else, is not immune from criticism, but eventually you have to confront the data, which has been found that it's certainly an effective long-lasting strategy. So the authors note that the naysayers are certainly going to have to come up with new data or new convincing interpretation to change their minds related to the effectiveness of momentum strategies. And they welcome anyone to say or show them any new information that contradicts what they've found here. And they also welcome any new myths that they can try to debunk. So they hope this study finally refutes all of the momentum critics' arguments against the effectiveness of momentum strategies.